As we move into 2026, the multifamily real estate market is being shaped by a mix of enduring fundamentals and near-term supply pressures. Each year, the National Multifamily Housing Council's annual conference brings together thousands of owners, investors, lenders, and operators to take the pulse of the industry. I attended this year's conference in late January, and today I want to share a few key themes and why they matter for investors and anyone following the future of rental housing. This year, if I had to summarize the biggest takeaway for 2026 in one line, it's this: equity flows where rent grows. And that really comes down to one word: supply. Not all supply is created equal, and it's impacting performance market by market, submarket by submarket. National deliveries are clearly trending lower, from roughly 600,000 units in 2024 delivered to about 400,000 in 2025, around 300,000 expected in 2026, and even lower levels projected beyond that. Demand is still there, but absorbing new supply gets more expensive in the markets with the biggest delivery wave. In fact, renewals have been doing most of the heavy lifting in 2025. Renewal rents average around 3.8%, while new lease tradeouts were closer to negative 2.5%. So what's that mean for 2026? The industry expectation is rent growth around 2%, gradually trending back toward longer-term norms in the years after. The key is where supply is concentrated. Most new deliveries have been clustered in high-growth Sunbelt and Mountain West markets, while other regions are seeing a more balanced supply and demand picture. That's a big reason why our focus remains appropriately boring. We're generally targeting well-located Class A and B assets in submarkets with healthier supply and demand balance and lower forward supply. And that's also reflected in where we've been allocating early in Fund 7, with focus in regions like the Midwest, Pacific Northwest, and Mid-Atlantic, where new supply has been comparatively limited. Now, we're still watching high supply areas too, because sometimes the best long-term opportunities come from buying quality assets at a challenging time in a cycle. If you can acquire at a meaningful discount to replacement cost, upside can emerge as concessions burn off, occupancies rise, and rent growth returns. If you want the full breakdown, including the data and what we're watching heading into 2026, I'd encourage you to read the full outlook.